update on some of the exciting things we're working on the technology innovation front, including Pathways Alliance. Next, Trevor Cassidy, our Chief Operating Officer for Conventional E&P, will provide a deeper dive into some of our natural gas, NGLs, light and heavy crude oil operations. Then Scott Stout, our Chief Operating Officer of Oil Sands, will provide an overview of our thermal in situ assets and our oil sands mining and upgrading assets. Mark Stainthorpe, our Chief Financial Officer, will then provide a marketing overview and provide details on our 2023 budget and our strong financial position. Tim will then provide a short summary before closure of the webcast, and we'll have a short break. Following the break, presenters will be joined on stage by our Chairman, Murray Edwards, for a senior management Q&A session, and we'll take some questions from the floor. Before moving on, I'd like to remind you of our forward-looking statements, and it should be noted that in our reporting disclosures, everything's in Canadian dollars, and we report our reserves and production before royalties unless otherwise stated. Additionally, I would suggest you review our comments on non-GAAP disclosures in our financial statements and in the advisory section of today's presentation. Today, we'll lay out how Canadian Natural's advantage drives premium value creation over the long term. Our advantages are our large, low-risk, high-value reserves, diversified balanced asset base, flexible capital allocation strategy, and effective, efficient operations that drives material free cash flow generation and strong returns on capital. Additionally, we're committed to leading environmental, social, and governance performance, which is a significant factor in our long-term sustainability. Next, I'll pass it over to Tim, who will go into more detail on the company's strategy and advantages.
Thank you, Lance. Good morning, everyone. Canadian Natural has a proven, effective strategy, and as a result, we have sustainable free cash flow through all the commodity cycles, ensuring we can deliver to shareholders. Our strategy is simply to optimize capital allocation to maximize value for our shareholders while ensuring we are maintaining a strong balance sheet. We have a defined growth value enhancement plan for every product and basin we operate in. Opportunistic acquisitions have always been a part of our strategy. However, we have no gaps, and in our portfolio, acquisitions need to make sense and add long-term value. We have a diverse and balanced asset base across various product types, which we can manage timelines, including our long-life, low-decline assets, to grow production and maximize its value. This is a significant difference to most of our peers. This is driven by our safe, effective, and efficient operations, our area knowledge, ownership, operatorship of infrastructure. We have a culture of continuous improvement, leveraging technology, innovation throughout the company, which gives us leading environmental, social, and governance. We have a history of capital discipline, operational excellence, low maintenance capital, all which results in maximizing free cash flow, giving more value to our shareholders. It's for these reasons Canadian Natural should be an investment priority. Canadian Natural has a successful track record of balancing our four pillars of capital allocation with a focus on maximizing shareholder value. Our four pillars are balance sheet strength, returns to shareholders, resource value growth, and opportunistic acquisitions. Our ability to generate significant, sustainable free cash flow ensures a strengthening balance sheet and sustainable returns to shareholders. We are prudent and disciplined in our allocation of resource development while maintaining flexibility to adjust if necessary. We have a strong track record of effective and efficient operations and low maintenance capital. Finally, opportunistic acquisitions have always been a part of the strategy. We have no gaps, and any acquisition must add long-term value. Balancing these four pillars with a focus on value creation maximizes long-term value. I will now talk to our significant reserves. Canadian Natural reserves are the highest among Canadian peers, showing the strength and depth of our assets, with approximately a 30-year reserve life index, of which 60% represents high-value SCO, light crude oil, and NGL reserves. As well, we have the largest natural gas reserves in Canada. Canadian Natural reserves can only be truly appreciated when you compare our total proven reserves to our global peers of greater than 5 billion BOEs. Canadian Natural is the only Canadian company on this chart, and it clearly shows the magnitude and the depth of our reserves. Canadian Natural's assets are unique in that we have effective and efficient operations, low maintenance capital. Volatile pricing has little impact on our NPV as we have low break-evens, large reserves, making our free cash flow robust and sustainable. We can grow our production cost-effectively during periods of high prices, and during low price periods, we can manage capital spending and it has little impact on the company's production. Our ability to manage through volatile pricing gives Canadian Natural a huge advantage compared to our peers, and this is why it should matter to shareholders. For example, in 2029 low price cycle, WTI averaged approximately $39 US. With our low operating costs, maintenance capital, and ability to manage our capital spending, we generated leading free cash flow. We had 6% production growth, maintained our debt levels, increased our dividend 13%, while many of our peers cut their dividend. Clearly, a Canadian Natural advantage. Then, as we moved into 2021, WTI pricing improved to approximately $68 WTI. Our low maintenance capital and operating costs, a disciplined capital program, we had production growth of 6%. We implemented our free cash flow policy as we generated significant free cash flow of $7.8 billion after dividends. Our year-end ending debt was under $15 billion. We increased our dividend by 38% and had share repurchases of approximately $1.6 billion. Significant numbers for Canadian Natural and shareholders. Canadian Natural's advantage is that our effective and efficient operations, large quality lands, and long life, low decline assets can deliver in all cycles. Canadian Natural's unique asset base has a low corporate decline rate at approximately 10%, with approximately 57% of our production being long life, low decline, or zero decline production, requiring less capital to maintain production. As can be seen on this chart, our 2023 budget, we have the lowest decline rate when compared to our peers, which gives us a maintenance capital at approximately $8 a BOE, giving us a big advantage. Our 3-year F&D costs are also one of the lowest, as our teams are focused and driven on adding reserves and development activities cost effectively across our high-quality asset base. Canadian Natural has a balanced and diverse product mix, with approximately 44% that's high value, light crude oil, SCO, and NGL on a BOE basis, 29% heavy oil, and 27% natural gas, limiting our exposure to one product. For our liquids production, 78% is from long life, low decline assets, which has low break even that delivers significant free cash flow. As well, we have approximately 2.2 BCF of natural gas, which is well positioned to capture improved pricing. On the marketing side, both our natural gas and liquids have a diverse sales strategy. On the natural gas side, 36%, or 798 million cubic feet per day, is sold to the export markets, while only 28% is sold at AECO. On the liquid side, we have SCO production of approximately 460,000 barrels a day, or 47% of our liquids garner a premium. While for heavy oil, we're only exposed to WCS pricing for 39% of our production. We are not exposed to one product or one market. I will briefly talk to the assets that both Trevor and Scott will talk to later this morning. Canadian Natural has a significant high-quality conventional land base in Western Canada, totaling approximately 23 million acres, which has approximately 7,500 premium locations in all the top-tier plays, which Trevor will talk to in more detail later this morning. Scott will talk to our thermal in situ, where our top-tier effective and efficient operations result in us having low break-even and having decades of cost-effective pad adds, which will add significant long-term value. As well, in the oil sands mining, our teams have done a great job, where Scott will show you how our top-tier, effective and efficient operations allow us to have superior safety, operating costs, and utilization, giving us high-margin SCO production. Over the next few hours, you'll see the depth and the quality, high-quality assets we have, and we have significant long-term value that we can add over time. This inventory gives us optionality and our ability to high-grade projects to deliver low-cost production growth, maximizing value over the long term for our shareholders. I'll now talk to returns on capital, delivering leading free cash flow and returns to shareholders. This year, prices have been quite volatile. However, on an average basis, WTI pricing has been quite strong at approximately $95 US. With our low-cost structure, a disciplined capital program, production will grow by 5%, and we've generated significant free cash flow of $11 billion after dividends. We target year-end debt of approximately $10 billion, and returns to shareholders have been significant. Dividend increased by 45%, and combined with our special dividend, totaled approximately $4.9 billion. Share repurchases of approximately $5.7 billion. Canadian Natural advantage is that our effective and efficient operations, high-quality lands, long-life, low-decline assets with low maintenance capital delivers significant free cash flow and value to our shareholders. When you look at ROCE, Canadian Natural is a real opportunity on a relative basis. In today's pricing, we see the potential of a 25% ROCE. However, on a relative basis to other industries, we're trading at just under 5 times EV to EBITDA. In our opinion, a discount to other industries and an opportunity for investors. Looking at the period 2019 to 2021, our 3-year ROCE, Canadian Natural, is superior to many of our peers, an indicator of the quality of assets, effective and efficient operations, and prudent allocation of capital across our assets. As a reminder, our free cash flow allocation is adjusted fund flows, less base capital expenditure and dividends, which generates significant free cash flow, which is allocated 50% to share purchases and 50% to the balance sheet, less strategic growth or acquisition opportunities. This has now been updated that once we achieve our $8 billion debt target, we will look to allocate 80 to 100% of free cash flow to incremental returns to shareholders, a significant opportunity for investors. If you look at 2022 returns to shareholders in detail, dividends were approximately $4.33 a share. Share repurchases were approximately $5 a share, or so over $9 per share was returned to shareholders in 2022, a significant number. Canadian Natural has a robust, sustainable free cash flow, and through the free cash flow allocation policy, returns to shareholders are significant. Our dividend will again increase, marking 2023 as the 23rd year of consecutive increases, and has a CAGR of 21% over that time. Our 10-year CAGR is top tier when comparing to our global peers, and it's clear we have a more robust, sustainable free cash flow, as our dividend, including special dividend, has approximately a 27% CAGR, more than double our nearest competitor. Production growth on a per share is also very strong, at 8% CAGR over the last 4 years. When you look at our free cash flow sensitivity from $70 to $100, it climbs very rapidly as a result of Canadian Natural having high-quality assets, effective and efficient operations, top-tier cost structure, low maintenance capital requirements, and a capital discipline program. In summary, Canadian Natural has a proven, effective strategy, and we're delivering in today's environment and will continue in the future. What you will see is more of this, more that we have more inventory for drill and fill growth projects embedded in our vast conventional assets and thermal pad adds that you'll see later this morning, that we can leverage off our existing facilities. As well, we have enhancements in our oil sands mining and upgrade segment that will add long-term value. Canadian Natural's ability to deliver significant free cash flow is driven by our effective and efficient operations, high-quality assets, low maintenance capital, and significant reserves. Our culture of continuous improvement is unique among our peers, as our teams are focused on delivering operational excellence across our asset base. We will continue to leverage technology and innovation and continue to reduce our environmental footprint. We have a history of capital discipline, safe, reliable operations, operational excellence, low maintenance capital, and we can show value growth and debt reduction, all which results in maximizing free cash flow, resulting in more value to the shareholders. Canadian Natural is truly robust versus our peers. I'll now talk to you briefly on some ESG items. Canada is a great country. It's one of the highest rated ESG countries among top crude oil exporting nations. It has a world-class CCUS infrastructure, which Canadian Natural is a significant owner. All parties, industry, provincial, federal governments are working together to achieve climate goals and ensure economic sustainability. Canada and Canadian producers can be a safe, affordable, reliable, and responsible supplier to the world through initiatives like Pathways, in which top Canadian oil sands producers have got together to reduce CO2 emissions and target net zero in the oil sands by 2050. Finally, we have strong, transparent reporting requirements, making it easy to follow our progress. If you look at the overall ESG performance, in terms of investment priority, it is very clear that Canada is a world leader and scores the highest in every category and should be an investment priority. With the recent announcement of Pathways securing the right to explore pore space, and with 70% of Canadian Natural's emissions related to the oil sands, it is now time to lay out our new corporate emissions reduction target, which is a 40% reduction in total Scope 1 and Scope 2 emissions by 2035. This plan includes the development of CCUS for the oil sands and other emission reduction projects, such as solvents. We will continue to leverage technology and innovation to reduce our methane emissions by 50% by 2030 from a 2016 baseline, as well as further reduce our freshwater intensity by 40% in both thermal and oil sands mining operations by 2026 from our 2017 baseline. Joy will go through more details of the work we're doing to meet these targets. Safety is a core value at Canadian Natural. It's in every aspect of our business as we target no safety incidents and no harm to people. Canadian Natural is delivering industry-leading performance with our overall TRIF down 49% from 2017 and a 67% reduction in total lost time incidents. I'm very proud of our teams with a strong focus of accountability from our frontline workers, and we are committed to deliver even better performance each and every year. Investing in Indigenous communities is important to Canada. And at Canadian Natural, we are working together with communities to help develop their companies and their people by providing training, business, and job opportunities. Most importantly, we're taking the time to understand and respect the community's perspectives and goals. We work together with more than 144 Indigenous businesses, and in 2021, we did approximately $572 million worth of business, making a significant difference in their communities. For governance, Canadian Natural has a strong and effective model. Our board, as well as our board HSE, governance, and risk committees, review and hold management accountable to identify and mitigate risks. The management committee works with various subcommittees to identify, develop strategies, and plans to address those risks. Then effectively execute those plans and deliver performance aligned with our shareholders. As well, over the years, Canadian Natural has continued to improve our reporting and better communicate all the technologies and innovations we are working on to become more effective and efficient in reducing our environmental footprint. In summary, Canada is a top-rated ESG country among top crude exporting nations. It has world-class CCUS infrastructure, which Canadian Natural is a significant owner. Canada and Canadian producers can be a safe, affordable, reliable, responsible supplier to the world. Through CO2 emission reduction initiatives like Pathways, all parties, industry, provincial, federal governments are working together to achieve climate goals and ensure economic sustainability. Finally, in Canada, we have strong, transparent reporting requirements, making it easy to follow our progress and hold us accountable. I will now turn it over to Joy Romero to talk, Executive Advisor, Innovation for Environmental Performance Overview.
Thank you, Joy, and good morning. Next, I'll provide an overview of Canadian Natural's high-quality E&P assets and the potential to add significant value-add growth from our assets. One of Canadian Natural's greatest strengths is our safe, effective, and efficient operations, coupled with a large and diverse portfolio of high-quality assets. On our extensive land base, we have a large inventory of premium locations proximal to our significant owned and operated infrastructure. This allows us to apply a proactive, disciplined, and flexible development strategy where we target liquid-rich plays. We leverage technology, innovation, and our continuous improvement to unlock production and reserves and reduce our costs and environmental footprint. This proven strategy maximizes free cash flow generation, thereby maximizing shareholder returns. As Tim highlighted in his section, in Western Canada, Canadian Natural has strategically positioned ourselves to have a significant exposure to many of the best, top-ranked E&P plays. Within our 23 million acre land base, the company has exposure to proven and emerging plays and has identified approximately 7,500 premium locations. This includes top-tier plays such as the Montney, Deep Basin, heavy oil, and Clearwater plays. At approximately 581,000 BOED, Canadian Natural is the largest conventional producer in Canada, and this is backed up by approximately 4.8 billion BOE of reserves, the largest of any Canadian E&P producer. The company's 2.1 BCF a day of natural gas production is supported by over 20 TCF of 2P reserves, which are the largest natural gas reserves in Canada. The company's 231,000 barrels a day liquids production is supported by approximately 1.5 billion barrels of 2P reserves, again the largest conventional liquid reserves in Canada. Our expansive infrastructure has over 300,000 BOED of net available capacity that allows for low-cost drill-to-fill developments. And by leveraging our drill-to-fill strategy, we can deliver low-cost growth, which adds more value than our peers. Next, I'll highlight a couple examples from our top E&P assets, first starting with the Montney and Deep Basin assets. On this slide, we have highlighted the top Montney and Deep Basin plays that Canadian Natural has significant exposure to, and where we have identified approximately 4,000 premium defined locations in these low-risk, repeatable plays. This next slide shows the industry average break-evens of the top E&P plays in gray, with the Montney and Deep Basin plays having the lowest break-evens. Layered on the slide is Canadian Natural's break-even costs for these plays shown in blue, which demonstrates the quality of our assets within these plays, as well as our focus on cost and productivity improvements that I'll detail in a few slides. This next slide shows an overview of our Montney and Deep Basin assets. As you can see, we have a dominant position in these areas with approximately 1.5 million net acres of Montney rights and approximately 1.8 million net acres of Spirit rights in the Deep Basin. Within these high-quality lands, the teams have unlocked an inventory of approximately 4,000 premium locations. These premium locations are proximal to our expansive owned and controlled infrastructure, make them high-value, low-cost, drill-to-fill developments. One of Canadian Natural's competitive advantages is our expansive owned and controlled, high-quality infrastructure that's proximal to our premium land base as outlined on the map. On the map, Canadian Natural has a total facility design capacity of approximately 2.8 BCF a day, with current throughput of approximately 1.7 BCF a day. This means we have approximately 1.1 BCF a day of net facility capacity that we can leverage for drill-to-fill developments. This allows us to control our costs and maximize value, as we can control the pace of development as well as quickly respond to market conditions. In addition, drilling to fill maximizes facility utilization and drives our unit operating costs lower, so with every development, Canadian Natural realizes even more value with additional free cash flow. Here at our greater Wembley assets, we have unlocked significant value in 2022 by drilling to fill our 200 million a day existing facility capacity from these liquid-rich lands. This higher facility utilization has resulted in lower unit operating costs, and with approximately 944 identified high-value locations, we can maintain these facilities at capacity for decades for low maintenance capital. In our 23 budget, we're targeting 17 drills to keep the facilities at capacity for a strong 12-month capital efficiency of approximately $7,300 per BOED. As well, we're looking at other high-value options to further increase production, like facility expansions. One example of Canadian Natural's focus on continuous improvement and sustainably lowering costs is our drilling and completion performance in the greater Wembley area. By implementing low-risk innovations, on the drilling side, we have delivered a 38% reduction in drilling costs since 2016, and on the completion side, we've realized a 30% reduction in completion costs since 2017. And where applicable, these cost savings are being applied across all our Montney and Deep Basin developments. And our teams are focused on finding ways to further optimize costs, continuing to offset inflation. In addition to cost reductions, Canadian Natural has delivered significant productivity improvements. In the greater Wembley area and in similar reservoir quality, well productivity has increased 68% since 2016, primarily by optimizing completion designs and drilling longer lateral lengths. This 68% productivity improvement is up from the 57% we outlined in the 2019 open house. And teams are continuing to find additional innovation to further unlock more productivity improvements going forward. We're currently producing approximately 2.1 BCF a day of natural gas and 110,000 barrels a day of NGLs and light oil. Currently, we have available drill-to-fill facility capacity of approximately 1.1 BCF a day natural gas and 55,000 barrels a day liquids. Further to this, we've identified optionality of approximately 0.7 BCF a day natural gas and 65,000 barrels a day of potential debottleneck and expansion opportunity. We have a significant potential to grow, and our disciplined and flexible allocation ensures capital is allocated to the highest return projects from the company's large inventory of opportunities. Our international assets provide Canadian Natural with approximately 28,000 barrels a day of light oil exposure to Brent pricing. We have a balance of low-risk development opportunities in Côte d'Ivoire, Africa, and high-impact non-operated exploration in South Africa. In 2023, the company is methodically progressing our next two low-risk developments. First at Espoir, we're targeting the next phase of development in 2025 to 2026, and second at Baobab, where we're targeting the next phase of development in 2026-2027. Over in South Africa, the operator has applied for production right status in September of this year, the first step to moving this development forward. Next, I'll highlight our top-tier heavy oil assets. Here we have highlighted the top heavy oil plays where Canadian Natural has significant exposure to, and where we have identified approximately 3,200 premium locations in these low-risk, repeatable plays. This slide is an overview of our heavy oil assets. We're the largest conventional heavy oil producer in Canada with production of approximately 120,000 barrels a day. As you can see, we have a large concentrated land base of approximately 3.2 million acres. And within these high-quality lands, our teams have unlocked a drilling inventory of approximately 3,200 locations. And these locations are proximal to our expansive owned and controlled infrastructure, making them high-value, low-cost drill-to-fill developments. Approximately half these locations utilize multilateral horizontal technology that I'll detail in the next slide. Next, we want to highlight the game-changing multilat technology that we're leveraging across our entire heavy oil land base. Horizontal multilat technology has significantly improved productivity and recovery by increasing the overall reservoir contact, thereby unlocking plays that were previously not economic. As well, multilaterals have also reduced our environmental footprint as we're able to access much more resource with a minimal surface footprint. A clear example of where technology has created significant value. This next slide outlines Canadian Natural's Clearwater and Pelican Lake assets. Our large 940,000-acre land base allows for strategic, cost-effective development. As the majority of our lands are winter access, we see multiple opportunities to methodically de-risk the different plays in a disciplined, low-cost approach. Once we de-risk a play, we can develop it quickly and for low cost, as they're proximal to our existing 100% owned and controlled Pelican Lake facilities, making them high-value developments. Smith is an example where we have done this recently. The Smith area is a Clearwater play where we have developed low-risk, repeatable, high-value locations that utilize the available capacity at our existing facility in Pelican Lake. As you can see on the slide, we have quickly ramped up production and are targeting approximately 90% increase in production to approximately 17,000 BOED in 2023. All this production is being processed by leveraging our existing Pelican Lake facilities, which has low operating costs. This is a good example where our teams have leveraged first our existing premium land base, our 100% owned and controlled infrastructure, and technology to exploit this play and create significant value in a short timeline. As well, in the Bonnyville to Lloydminster corridor, we have been leveraging the horizontal multilat technology across our large land base since 2019. Originally, developments in this area started out as vertical wells, then to slant well technology, and now to horizontal multilat technology, further improving capital efficiency as well as opening up new plays. Here we have approximately 1,260 defined multilat well locations in close proximity to our existing infrastructure. Building upon our success in 2022, in 2023 we're targeting to drill 133 multilateral wells at strong capital efficiencies of approximately $10,800 per BOED. This will grow our multilat production to approximately 23,000 BOED, or 60% annual high return growth. Another example where teams have leveraged the existing premium land base, our 100% owned and controlled infrastructure and technology to create significant value in a short timeline. Another example of Canadian Natural's focus on continuous improvement and sustainably lowering costs is our success at improving multilateral well performance. Since 2018, the teams have delivered 42% improvement in capital efficiency by capturing 38% more reserves and 50% higher productivity, primarily by drilling longer wells. As well, we see approximately 2.5 times less surface disturbance using multilat technology over slants, thereby reducing our environmental footprint and saving costs. Again, Canadian Natural is focused on cost efficiencies, and our continuous improvement culture has delivered good success leveraging this technology. I fully expect over time, we'll continue to unlock further optimizations of this game-changing technology. A key component of our long-life, low-decline, heavy crude oil assets is our world-class polymer flood at Pelican Lake. the largest polymer flood in North America. Pelican Lake is a high value with its long life, low decline, and low operating costs. Pelican Lake has and will continue to deliver significant free cash flow and return to shareholders for decades. Our heavy oil assets provide a balance of low capital exposure and long life, low decline assets. Currently, our heavy oil production is approximately 120,000 barrels a day, and we have significant potential to create additional value by leveraging our approximate 3,200 premium locations and our 67,000 barrels a day of drill-to-fill facility capacity, which ultimately grows our free cash flow for low cost, thereby maximizing shareholder returns. Now looking across all our E&P assets, currently we are producing approximately 581,000 BOED. We have the potential to grow by leveraging our large inventory of locations and the company's approximately 300,000 BOED of available drill-to-fill facility capacity, ultimately delivering low-cost, high-return free cash flow growth. Over and above that, we have identified approximately 190,000 BOED of potential value-add growth optionality by debottlenecking existing facilities and developing new facility expansions. In summary, our safe, efficient, and effective operations offer a large inventory of premium, low-cost development optionality. Our disciplined and flexible capital allocation ensures capital is allocated to the highest return projects from the company's large inventory of opportunities. We're continually high-grading our large inventory by leveraging our culture of continuous improvement that has and will continue to deliver improvements with the successful application of technology and innovation, ultimately delivering significant free cash flow and maximizing shareholder returns from all our E&P assets. Thank you for your time. Now I'll hand over to Scott Stauth to highlight our...
Thank you, Trevor, and good morning. Today I'm going to talk about our thermal and mining oil sands assets. First, we will go through our thermal in situ assets. Starting with our thermal strategy, we are clearly focused on driving free cash flow and maximizing returns to shareholders. Our long life, low decline assets drive value, and we maximize that through safe, effective, and efficient operations. Our teams are focused on maximizing near-term value and cash flow by being nimble with development opportunities. Our low WTI break-even price protects us through commodity cycles, and we have the opportunity to leverage our facilities with potential for larger growth developments. We strive to improve our efficiencies utilizing technology with innovation, and we have the technical expertise to execute on these efficiencies. That, combined with our strong culture of continuous improvement to reduce our costs and improve our SORs, results in strong free cash flow and returns to shareholders. Canadian Natural's thermal assets are vast, with over 4 billion barrels of 2P reserves and production of approximately 253,000 barrels per day forecasted in 2022. Our largest producing assets are Primrose, Jackfish, and Kirby that have a total facility capacity of 340,000 barrels per day. We have 95,000 barrels per day of available facility capacity, resulting in significant opportunity for future growth at low cost. We are an effective and efficient operator with over 23 years of experience focused on utilizing 3 distinct thermal processes tailored to specific reservoirs: CSS, SAGD, and steam flood. These processes, combined with immense land holdings and technology enhancements such as solvents that we continue to progress through our pilots and SAGD commercial scale at Kirby, allows Canadian Natural the ability to capture significant value. We are focused on reducing our greenhouse gas emissions on our thermal assets through a stage approach, which aligns with the Pathways plan that Joy talked about earlier. This slide shows that our thermal assets have a top-tier WTI break-even price. Our thermal assets remain profitable at a much lower WTI price than the vast majority of our peers. This is a result of our focus on effective and efficient operations, which includes lowering operating and maintenance costs, delivering superior returns to our shareholders. In more detail, our leading break-even metrics are 9% below the peer average, which results in $500 million of additional annual free cash flow compared to our peers. This is a good illustration of how our culture of continuous improvement drives down our costs and maximizes value. This slide shows Canadian Natural's massive long-life, low-decline reserves of over 5 billion barrels, which includes the forecasted reserves associated with the acquisition of Pike earlier in 2022 that will provide significant drill-to-fill opportunities and growth potential for decades while requiring minimal maintenance capital. One of our strengths is our significant infrastructure. An example of this is our Primrose and Wolf Lake areas with over 140,000 barrels per day of facility capacity and approximately 65,000 barrels per day available for development opportunities. We have approximately 2,000 locations identified as economical at $70 US WTI. We forecast an increase of approximately 20% recovery over CSS using steam flood and costing very little capital because we are able to utilize existing CSS horizontal wells. We have significant opportunities at Primrose and Wolf Lake, including SAGD and solvent-enhanced steam flood, as we continue to monitor our two-year solvent-enhanced steam flood pilot, which began in November of 2021. Results at this stage look very good, with SOR reductions of approximately 50%. Looking at Primrose in more detail, we have significant opportunity to fill our facilities to capacity if we choose to do so. Earlier this year, we drilled 2 CSS pads on time and on cost that will come on stream in Q3 of 2023 with excellent capital efficiency of approximately $10,000 per barrel per day and average pad production rates of 12,000 barrels per day. We can easily control our pace of development to fill our facility capacities. What's even more impressive is we have identified over 100 future additional pad locations that we can leverage with our facility capacity. Our large SAGD operations in Kirby and Jackfish are another great example of how we add significant value through economies of scale. We have 5 100% owned processing facilities, 3 in Jackfish and 2 in Kirby, each of which has the capacity of approximately 40,000 barrels per day. We have approximately 1,000 locations and 30,000 barrels per day of available capacity, making our SAGD assets another great example of our strong infrastructure capabilities. In Q1 of this year, we acquired the remaining 50% working interest in the Pike lands, adding significant value as we control our pace of development, ensuring we maximize returns. The combined Kirby, Jackfish, and Pike assets help drive economies of scale, and our advancement of commercial scale solvent pad in Kirby in 2024 has the potential to add even more value to our portfolio of SAGD development opportunities while driving down operating costs as we leverage our operating and technical expertise across our extensive long-life, low-decline asset base. In Jackfish and Pike, we have significant opportunity to fill and maintain our facilities at capacity. In 2023, we plan to drill 3 pads that will come on stream in 2024 with excellent capital efficiencies of approximately $8,500 per barrel per day and average production rates of 9,000 barrels per day per pad. We can easily control our pace of development to fill facility capacities. Our teams have identified a massive inventory of over 75 future additional pad locations that we can deliver through low maintenance capital requirements. In Kirby and Pike, we also have significant opportunity to fill and then maintain our facilities at capacity. We have completed drilling on 2 pads on time in 2022, and a 3rd pad will be finished in early Q1 2023. The first pad will ramp up to full capacity in Q3, and the next 2 pads ramping up to full production in Q1 of 2024, with average rates of 8,000 barrels per day per pad. We have strong capital efficiencies of approximately $10,000 per barrel per day. Going forward, we can easily control our pace of development as we have significant inventory of over 45 pad locations. Following our success of Kirby solvent pilot, we continue to move forward, unlocking more value with our solvent-enhanced steam production opportunities and our first commercial-sized solvent SAGD pad in Kirby North. Drilling has just finished up and the site was turned over to surface facilities construction. The solvent facilities engineering work is near complete and certain major equipment awards have been made. We are targeting butane solvent injection in Q1 of 2024. As a reminder, the benefits of co-injection are reduced operating costs, reductions of SOR and greenhouse gas intensities by up to 50%, and it unlocks capacity for potential growth opportunities as it has significant application throughout our thermal SAGD asset base. Similarly, our co-injection opportunities on our Permos assets continue to be evaluated as we monitor results at our Permos pilot on SOR reduction and solvent recovery, which are key for economic success. Again, the potential here is significant on our vast CSS assets. Leveraging technology, innovation, and Canadian Natural's culture of continuous improvement has resulted in significant cost reductions that have allowed us to capture an impressive 17% in drilling cost per meter, while at the same time increasing overall well lengths by approximately 30%. This improved well design, combined with drilling efficiencies, lowers overall development costs and drives strong thermal capital efficiencies. We have significant growth potential with over 3,000 identified locations. We have the potential to add 95,000 barrels per day at strong capital efficiencies of $9,500 per barrel per day, simply by filling our existing facilities to capacity of 340,000 barrels per day. Our infrastructure and inventory provide Canadian Natural with significant advantages and long-term optionality with massive value. Our long-life asset base of low-decline production has significant potential to unlock even more value by capturing low capital cost, delivering incremental production capacity of 185,000 barrels per day to fill our facilities through the commercialization of solvent. With the addition of solvents, we target to reduce our SORs by approximately 50% and free up steam capacity at existing facilities. With expansion potential in areas such as Kirby and Jackfish, for example, and the implementation of solvents, we can add massive 300,000 barrels per day through safe, effective, and efficient operations. As you can see, we are clearly focused on driving free cash flow and maximizing returns to shareholders. We will continue to maximize through safe, effective, and efficient operations, and we continue to enhance the value of our long-life, low-decline assets through strategic timing of development. Our teams are focused on executing our plan to leverage our infrastructure. We combine continuous improvement along with technology and innovation to enhance efficiencies, and we have the technical expertise to execute on our opportunities. We are nimble, and we can add production quickly if we choose to do so based on market conditions, and we will continue to focus on costs, SOR reductions, and greenhouse gas emission reductions, all of which will continue to result in strong free cash flow and returns to shareholders. Switching to our mining assets. Our oil sands mining assets mining strategy is to deliver maximum value through safe, effective, and efficient operations. We have high utilization, and we leverage technology, innovation, and continuous improvement to provide strong operational results. We are focused on strong safety performance, operating costs, optimizing production, and we won't take our eye off reliability. We continue to progress opportunities to increase economic production in the midterm, and our teams are primarily focused on maximizing near-term value and cash flow. Our mining assets offer decades of no-decline synthetic crude oil production with no reserve risk, and continue to deliver significant operating free cash flow via our lower operating and maintenance costs. Canadian Natural is an industry-leading oil sands mining operator. In 2023, oil sands mining and upgrading capacity will be 480,000 barrels per day, as we are adding an incremental 5,000 barrels per day of high-value SCO next year. These massive assets contain approximately 7.5 billion barrels of proved plus probable SCO reserves with over 50 years of reserve life, making this a world-class operation. The resource is massive at approximately 18.4 billion barrels in place. Our top-tier operating costs and low maintenance capital capture even more value through high-quality SCO barrels with no decline and no reserve risk. We have the advantage of the economy of scale with our Horizon and Albion mining operation. Our teams are focused on safe operations, optimizing the cost structure with a strong continuous improvement culture. I will show you that journey of effective and efficient operations on a forward slide. Canadian Natural clearly leads the industry in utilization. This is a key factor in our operations group, with safety and reliability a key focus. Our teams are clearly focused on delivering high utilization through safe, effective, and efficient operations. We target to maximize the capacity of all the assets from the mine operations through to the upgraders. This chart shows this is one of our significant strengths. Our culture of continuous improvement is relentless. This graph shows the effect of reducing our operating costs by over $18 per barrel over the past decade, delivering a massive $2.8 billion of additional margin in 2022. We are relentless with our continuous improvement culture, and we look at every area of spend, breaking it down into small individual targets because small dollars add up to a big number. This is how we run our business. Canadian Natural is clearly a cost leader and something our team is very proud of. This slide shows the value of our world-class mining assets with industry-leading WTI break-even price for both Horizon and AOSP. It clearly sets us apart as we focus on effective and efficient operations to deliver superior returns to our shareholders, as evidenced in this next slide. Our break-even metrics are a clear differentiator at 41% below the peer average, which results in a massive $4 billion of annual free cash flow advantage over our peers. Our reliability project at Horizon will add 5,000 barrels per day of SCO in 2023 as we progress the work, and in 2025 our capacity increases to a total of 14,000 barrels per day from this project. This is a significant volume adding opportunity because starting in 2025, Horizon will only be requiring a major turnaround once every 2 years. In addition to that, we will save approximately $75 million in capital costs in 2025 and increasing our margins by $1.50 per barrel based on fixed costs. This is a significant value-adding project at Horizon that adds incremental zero-decline SCO production for decades to come. We continue to look for opportunities to creep production as we execute this reliability project. We are targeting $280 million of capital investment over the next 2 years as we complete the project. A midterm opportunity for us is a project that has the potential to add 15,000 barrels per day of SCO. We are reviewing our upstream bitumen production facility requirements for processing capacity enhancements, and in the upgrader, we are performing feed engineering to ensure we have analyzed every opportunity to optimize project costs, and we are targeting an execution schedule of 2025 to 2028 should we decide to move ahead. We continue progressing work on our in-pit extraction process, or IPEP. We believe this opportunity has three very significant advantages. First, it reduces our overall mining operating costs by $1 to $2 per barrel. Second, it significantly reduces our greenhouse gas emissions by using fewer haul trucks. Third, it eliminates the need for tailings ponds and thereby significantly reduces long-term reclamation costs. These extraction facilities will be modular components so that they can be moved as we advance the mine phase. We have completed front-end engineering of a 750 ton per hour demonstration plant, and our next step is to kick off detailed engineering. The purpose of this 750 ton per hour plant is to demonstrate and evaluate how these modules will perform in a combined 6,000 ton per hour extraction train. One of our current main goals in our engineering review is to ensure we get it right in terms of the capital cost, expected maintenance and operating cost, as well as reliability performance. Another way we can grow our mining production is our paraffinic froth opportunity, where we can add 75,000 barrels per day of bitumen capacity to Horizon. This is an increase of 30,000 barrels per day from our last update as we work through engineering and process improvements. We are at the engineering design specification stage with this opportunity, and we were working on the synergies of combined commercial scale IPEP to create the upstream capacity to fill the froth plant. We continue to prudently advance engineering at Horizon on the froth treatment opportunities, and again, we will align this with favorable market conditions. When we leverage IPEP and paraffinic froth together, we have significant opportunity to add 75,000 barrels per day of mining production while lowering our greenhouse gas emission intensities and reducing our operating costs by roughly $3 a barrel. We currently estimate the cost of the project to be approximately $5 billion, which would be spread out over approximately 15 years, with IPEP being built in stages. Canadian Natural has many opportunities, and one of the most significant is the development of the next phase of oil sands mining. You can see by this slide the potential could deliver massive growth with no decline. If we choose to do so, we could add 260,000 barrels per day at Horizon Phase 4, 100,000 barrels per day at Jackpine, and 250,000 barrels per day at Pure River, totaling 610,000 barrels per day. We will only do this development under a very disciplined capital program that is aligned with our strategy and market access conditions. In total, with current production, near and mid-term long growth opportunities, our oil sands mining assets have the potential to produce over 1.1 million barrels per day of SCO, primarily SCO volumes, while lowering our greenhouse gas intensities with no decline and no reserve risk for decades. Truly a world-class asset. In summary, our oil sands mining strategy continues to deliver maximum value through safe, effective, and efficient operations. We will continue a strong focus on high utilization, and we will also continue to leverage our technology, innovation, and continuous improvement to enhance our performance. Our teams are laser focused on operating costs, reliability, optimizing production, and strong safety performance is at the forefront of everything we do. We continue to progress opportunities to increase economic production in the midterm, and our teams are primarily focused on maximizing near-term value and cash flow. Our mining assets offer decades of zero decline synthetic crude oil production with no reserve risk, and continue to deliver significant operating cash flow, free cash flow via our lower operating and maintenance costs. Our top-tier performance is a competitive advantage, and with our culture of continuous improvement, we will continue to drive significant value to our shareholders. Thank you, and now we will turn it over to Mark to present our marketing, finance, and 2023 budget.
Well, thanks, Scott, and good morning, everyone. Thanks to all of you who showed up today and took the time to come out, and also for those of you on the webcast, thank you for tuning in and listening today. As Scott mentioned, I'm just going to discuss a few important marketing topics here before going into our 2023 budget, and then also our strong financial position. So our strategy for maximizing the value of the products we sell is to maintain a degree of balance across all commodity types, including natural gas, synthetic crude oil, light and heavy crude oil, and we support egress and infrastructure to ensure our products get to the right markets at the right time. We focus on creating and optimizing our options for things like blending and transportation, and we support improving overall processes to drive value for our products. We participate in conversion capacity by upgrading bitumen and heavy oil to balance product mix and maximize our netbacks. Our large and diversified portfolio gives us an advantage to optimize our marketing strategy, to better manage in lower commodity price environments, and participate and maximize value in higher commodity price environments like we are in today. So first, I'll just go over some natural gas topics here. This slide shows the Western Canadian Basin, with the green line representing natural gas supply. In the period 2016 to 2021, low natural gas prices meant less investment, and that led to flat to declining supply. Over the last couple of years, natural gas prices have improved. This, of course, creates more investment and ultimately more supply. This increased supply comes with some challenges related to available transportation, particularly in times of maintenance, and can cause some disconnects in sales points pricing. However, currently there are no constraints on firm contracts for natural gas leaving the basin during periods of low maintenance. However, there are constraints during periods and during maintenance periods, and we did experience that in 2022, and these constraints are expected to continue in 2023. This requires strategic planning to mitigate price exposure and requires system improvements or expansions to mitigate going forward. In the near term, in 2023, there are two expansions targeted to come on stream, including TC expansion of 150 million cubic feet per day to Empress and 265 million cubic feet per day to Westpath delivery to the U.S. markets. In the midterm, LNG Canada is targeted to start delivery of LNG in 2025 and will support egress of about 1.8 BCF a day, which is expandable to 3.6 BCF a day. Other LNG and the T-South expansion in the 2027 and 2028 timeframes target to deliver another 1 BCF of egress capacity. So we do expect challenges and volatility in pricing, but particularly in times of maintenance. And at Canadian Natural, we have built a portfolio to manage the challenges and provide upside as egress alleviates. This portfolio has diversified sales points that drive strong netbacks. Our balanced portfolio has allowed Canadian Natural to capture significant value. Only 28% of our 2023 budget production of about 2.2 BCF a day is exposed to the AECO market. The equivalent of 36% of our production is required internally at Horizon, Albion, and our thermal projects, and creates a natural hedge. The remaining 36% are export volumes that have been successful in capturing market pricing that has been significantly greater than the domestic AECO market, resulting in over $385 million in incremental margin over the 2022 timeframe. This demonstrates how the diversity and flexibility allows Canadian Natural to maximize the value of its natural gas production. Now just moving on to some topics on the crude oil side. If you look at this graph shows the egress capacity out of Western Canadian Basin for crude oil, and you can see how it balances with the basin supply forecast in 2023. It also shows that the Trans Mountain expansion targeted for completion in late 2023 egress is balanced well into the future. At Canadian Natural, we balance our product mix on the crude side to maximize the value of the products we sell. Our production mix is over 60% synthetic crude oil, light crude oil, and NGLs, which are higher value. Canadian Natural has benefited from SCO premiums to WTI in 2022. These premiums are a result of our synthetic crude production having characteristics that refiners like for producing diesel. With the current low inventories for diesel in North America, we target our synthetic oil barrels to continue to be in high demand. As you see here, about 39% of our liquids production is heavy oil, where we generate strong netbacks as a result of the improved egress and our low-cost structure. This chart shows how there is no discount for Canadian heavy crude oil as a result of insufficient egress. As you can see, when we were constrained back in 2018, the U.S. Gulf Coast price for heavy crude oil, adjusted for transportation, was trading about $15.40 per barrel higher than heavy oil at Hardisty in Alberta. Fast forward to Q3 2022 and the 2023 strip, you see that the difference in price between U.S. Gulf Coast heavy oil and heavy oil at Hardisty adjusted for transportation are 70 cents and 20 cents per barrel respectively, meaning egress is not an issue. As releases from the U.S. Strategic Petroleum Reserve and maintenance activities get completed for refiners in North America, we expect the differential to improve for both U.S. Gulf Coast heavy crude oil and heavy crude oil at Hardisty through 2023. And that, of course, is what the current 2023 forward strip indicates. This map shows the current areas where Canadian crude is consumed in both Canada and several points in the U.S., as well as the major pipelines that move Canadian crude oil today. The Enbridge Line 3 replacement project added sufficient takeaway capacity to balance the market, and the next important project for Canada is the TMX expansion to the West Coast. The Trans Mountain expansion project will add 590,000 barrels per day of incremental takeaway capacity and is an important project for Canada as we get more of our responsibly produced oils to world markets. Canadian Natural has 94,000 barrels per day of firm capacity on TMX, further diversifying our portfolio, with the project targeted for completion in late 2023. In summary, our large and diversified product mix provide advantages to how we manage, support, and optimize our business over the long term, while maintaining optionality to maximize prices for our products and generate increasing returns to shareholders. I'll now switch gears and provide some detail around our 2023 budget, our strong financial position and where we are, and continue to strengthen that position as we go into 2023. Our strategy for the 2023 budget is to remain disciplined in our capital investments, and we are in an enviable position with low maintenance capital and top-tier high-value opportunities to execute in the near term while setting up for the future. You saw this in both Trevor and Scott's presentation, where we are opportunity-rich, providing us with the ability to deliver on the best value projects. The prudent 2023 budget also provides for significant free cash flow generation at current strip pricing, resulting in further returns to shareholders and continued strengthening of our already solid financial position. Canadian Natural has a long history of successfully balancing what we call our 4 pillars of capital allocation, with a focus on maximizing shareholder value. The 4 pillars are balance sheet strength, returns to shareholders, resource value growth, and opportunistic acquisitions. We have a strong track record of effective and efficient operations, and with our low maintenance capital, it supports our ability to generate significant and, importantly, sustainable free cash flow, ensuring a strengthening balance sheet and sustainable and growing returns to shareholders. And as we've mentioned, we are prudent and disciplined in our capital allocation to resource development while maintaining flexibility to adjust when necessary. Finally, opportunistic acquisitions have always been a part of our strategy. However, we have no gaps in our portfolio, and as a result, any acquisition must compete and add long-term value to our shareholders. For 2023, we have a base capital program of $4.19 billion that is targeted to add year-over-year BOE production growth of about 56,000 BOEs a day, with strong production volumes in both the conventional natural gas and liquids production. Additionally, we have allocated $1 billion to strategic growth capital, largely targeting future growth in the thermal and oil sands mining areas. This capital budget drives year-over-year average production growth in all segments, as you see here, with both overall natural gas production growing about 5% and liquids productions growing by approximately 4 to 5% from 2022 levels. When you take into account the significant free cash flow generation from these capital and production levels, combined with executing our free cash flow policy, we target to generate 8% production per share growth in 2023 from 2022 levels. We will be delivering this production growth with a very disciplined drilling program of about 70 natural gas wells, 260 net conventional crude oil wells, and 54 thermal wells. This prudent drilling program will provide opportunities for continuous improvement, maximize the ability to be effective and efficient, and manage our costs to ensure we are driving towards top-tier returns on capital. Our plan is to deliver on the 2023 capital and production budget in a safe, reliable, effective, and efficient way by executing a program focused on top-tier plays within our vast asset base. By having defined plans and a culture of continuous improvement, we can drive significant free cash flow and returns on capital. Our premium assets, top-tier execution, and cost structure give us the ability to target to add production, progress projects for future production, strengthen the balance sheet further, and continue to deliver increasing returns to shareholders in 2023 and beyond. And I'll move on just to talk a little bit about our financial strength. At Canadian Natural, we are generating material free cash flow, and we target to maximize returns to shareholders by having a unique free cash flow allocation policy that delivers increasing returns to shareholders while strengthening the balance sheet at the same time. Our financial position is very strong today, and that provides maximum flexibility on how we can execute things like strategic growth without impacting returns to shareholders. The goal is to create long-term shareholder value. What sets Canadian Natural apart is the quality of our assets and people. The long-life, low-decline nature of our production with low maintenance capital and our culture of continuous improvement. This Canadian Natural advantage was evident in 2022 and sets up momentum to continue to deliver top-tier results as we go into 2023. 2022, we were able to grow production about 5%, generate more than $11 billion of free cash flow after dividends, reduce absolute debt, and increase our dividend twice by 45% to $3.40 per share, and declare a special dividend of $1.50 per share, and finally executed a significant share repurchase program of over $5.5 billion. These are impressive results and demonstrate the uniqueness and upside potential at Canadian Natural. Canadian Natural's free cash flow allocation policy is unique in that it provides flexibility given the strength of the financial position. Free cash flow for the purpose of the policy is defined as adjusted funds flow less base capital expenditures less dividend. The policy states that since the company's absolute debt level is below $15 billion, 50% of the free cash flow is targeted to share repurchases under the NCIB, with the remaining 50% allocated to further strengthening our balance sheet, with any acquisition or strategic growth capital not impacting returns to shareholders. A further enhancement we announced today to the company's free cash flow allocation policy is that when the company's net debt reaches $8 billion, the company intends to allocate 80 to 100% of free cash flow as incremental returns to shareholders. This policy ensures we maintain a strong balance sheet while increasing returns to shareholders. I'd just like to highlight a couple items on the balance sheet. Our financing strategy includes maintaining balance sheet strength while maximizing financial flexibility. Balance sheet strength is core to Canadian Natural. The financial position is very strong today. Debt to book capital at 24%, debt to adjusted funds flow 0.6 times at September 30th, and with our free cash flow allocation policy is targeted to strengthen even further. We also maintain a flexible capital structure with a focus on managing maturities. And as part of our robust financial position, we maintain ample liquidity to support delivering on our financial plan. Total liquidity at September 30th was significant at about $6.5 billion, including cash and short-term investments. Investment-grade credit ratings are important to us, and in 2022, both Moody's and DBRS upgraded our credit ratings to Baa1 and A low, respectively. We have a strong and very supportive banking group with long-term relationships comprised of world-class Canadian, U.S., and Asian financial institutions. At Q3, we repaid all of our outstanding bank debt and commercial paper, and our revolving facilities alone provide over $5.5 billion of liquidity. We have a purposeful and prudent debt maturity profile that provides the opportunity to repay absolute debt in the near term. We have also executed about $500 million of bond repurchases in 2022, and we will early redeem in Q4 22 our $1 billion U.S. bond originally maturing in January 2023. At current strip pricing in 2023, debt to book capital and debt to adjusted funds flow are targeted to continue to strengthen to approximately 16% and 0.5 times respectively. Having a purposeful and prudent maturity profile has given us the opportunity to cost-effectively pay down more than $13 billion of net debt since the end of 2020 through 2023, allowing us to strengthen metrics through the cycle and demonstrate the resilience of our assets and business model. Finally, I'll just discuss a few items and reiterate some messages around the free cash flow and returns to shareholders. This chart shows the significant returns to shareholders we have been able to deliver in 2022. We have returned $4.33 per share in dividends and over $5 per share in repurchases, totaling more than $9 per share in direct returns to shareholders, and provided indirect shareholder returns of over $5 per share in the form of balance sheet deleveraging. The sustainability of our business model and the ability to deliver returns to shareholders over the long term is proven in our dividend history, particularly when compared to a global peer group. Canadian Natural's dividend has not only been sustainable, but our compound annual growth rate over the last 10 years is leading, 21%, or 27% including the special dividend this year, significantly higher than the peer average. And this chart demonstrates the history of growing returns to shareholders through the dividend, with 23 years of consecutive dividend increases, representing a 21% CAGR over that time period. It's important to note that our dividend has been able to grow through all commodity price cycles. In 2022, you see the balance in returns to shareholders through the $1.50 per share special dividend and a significant share repurchase program. When you put returns to shareholders into the context of market cap, the results are impressive. Our free cash flow generation is targeted to continue in 2023 with significant returns to shareholders, and at current pricing would see a return of approximately $16 per share of direct return to shareholders over the 2-year period. What is unique is that while we continue to deliver significant returns to shareholders and further balance sheet strength, we can also continue to grow our business. As you can see here, we have been able to generate about an 8% CAGR production per share growth since 2019, with 2023 growth also targeted at 8% per share compared to forecasted 2022 levels. This is a reflection of what sets Canadian Natural apart from the global peer group, the ability to invest and effectively grow while returning significant cash to shareholders. The commodity markets continue to show volatility, and at Canadian Natural, we focus on how to be resilient through the cycle and generate future upside. The advantage at Canadian Natural is our low maintenance capital, long life, low decline, and diverse product mix, so we're never hostage to one commodity price, and our relentless focus on effective and efficient operations with top-tier cost structures drives significant and sustainable free cash flow at lower commodity prices, while our size provides significant torque to commodity price upside. In summary, our world-class assets set us apart. These assets are high-quality reserves with low overall declines and a top-tier cost structure. When you combine that with our culture, a culture of continuous improvement, with a focus on return on capital and doing it right, we can drive material free cash flow and maximize returns to shareholders over the long term. Thank you very much, and I'll pass it back to Tim here for some closing comments.
Thank you.